Jim. So I'd like to discuss with you a couple of the critical audit areas that we looked at during our engagement this year. And we have given you a kind of a slide presentation handout there. It's on the second page. Some of those areas as listed, when we look at your cash and investments, some things that we look at there are your restrictions for your capital projects and your debt service requirements. In your property and equipment, we look to make sure that the proper accounting has been followed. And this last year, you had over $75 million in additions to your property and equipment, just a little under $20 million in retirements, and then you moved about $559 million from construction in progress put into use. When we look at your pension and OPEB, real key there is whether you've met the disclosure requirements. We look at the actuarial data set that's provided and the underlying assumptions and methodologies used. Regarding your lease and leaseback transactions, those transactions have occurred. They're in the past. However, there's ongoing accounting and note disclosure requirements that need to be met. Regarding your debt, we look at compliance requirements and specifically those related to your state and local requirements. We make sure that they have been spent according to the intent. We also, as Jim mentioned, we look at the Oregon budget law and Oregon minimum standards, and those are the requirements that are set out by the Oregon Secretary of State. On the next slide, that's where it gets to the results, and this is where we want to talk to you about our reports and the opinion and the findings. As already mentioned, on your financial statement opinion, we are issuing a clean opinion, non-qualified opinion. It doesn't get any better than that, so congratulations. On the Oregon minimum standards, I just want to mention a couple of things that we do look at there to better define what that is about. We look at your accounting records and your internal control structure. We look at various depositories to make sure that the deposit of public funds is safeguarded. We look at requirements relating to debt and your annual budgeting process. We look at insurance and fidelity bond coverage, programs funded wholly or partially by other governmental agencies. We look at the requirements pertaining to the investment of public funds, and we look at your public contracting and procurement practices. The results of our procedures there have no findings to report to you, so everything met expectations and the compliance requirements. Regarding your A-133, or the single audit, the federal compliance requirements, we have no findings to report to you in this area either. We also help facilitate the submission of your data collection form. It describes all of your federal funds and the amount of expenditures for the year. It's also part of the requirement. And again, overall, we have no material weaknesses, significant deficiencies, or other matters to report to you today. We do have one other piece of communication, and that is in the second handout that I've given you. This letter is in response to Statement of Auditing Standard 114, communication with those charged with governance, which is the board here today. As already described to you, we have conducted the audit in accordance with generally accepted auditing standards. We have conducted the audit, the scope of the audit within the planned timing as described in our engagement letter. The qualitative aspects of your accounting practices, management is responsible for the selection and implementation of appropriate accounting practices, and those policies are described to you in Note 1 to the financial statements. There were no new accounting policies, no changes in the application of existing policies, no transactions entered into during the period for which there was a lack of authoritative guidance, and there were no significant transactions that have been recognized in the financial statements in a different period in which the transaction occurred. The district has adopted GASB 51, which is the accounting and financial reporting for intangible assets as capital assets. And also one of the other elements, and I'm not going to say a lot about it right now because Jim is going to address it in just a little bit, and that is the responsibility for your pension plan reporting. Regarding significant accounting estimates, estimates are a very important part of your financial statement reporting. And they are exactly that. They're an estimate. They're based on your past history, current conditions, and what we believe is going to happen in the future. Some of those estimates that are key to employment include your payroll and self-employment taxes receivable, the useful lives of property and equipment, your claims liability, your employee benefit plan accruals, your overhead allocations, the fair value of your derivatives, and capital interest. We concur with the significant estimates and assumptions that have been made by management in the preparation of your financial statement. Regarding key financial statement disclosures, a couple of them that we'd like to point out to you. In Note 3, you discuss your interest rate risk, credit risk, concentration of credit risk, and custodial credit risk. Note 4 addresses your diesel fuel hedge. disclosure. Your employee benefit discussion is in note 7 and 8. Your debt requirements is in note 9. Your risk management claims is in 10. And your lease transactions are in note 12. We encountered no significant difficulties in dealing with management, performing, and completing our audit. We had no uncorrected misstatements to the financial statements as a result of our audit. We had no disagreements with management during the course of our audit regarding financial accounting, reporting, or auditing matters. We have obtained management representation, which is dated September 20th, which is the date of our opinion. And we are not aware of any situation where management went out and shopped for a second opinion, which would make sense since we gave you a clean opinion. You can't get anything better, so there's not a whole lot of motivation to shop for a second opinion. But to our knowledge, there was no such communications with other accountants. All discussions during the course of our audit occurred in the normal course of our professional relationship, and our responses were not a condition of our retention as your auditors. We also communicate to you issues of internal control matters, and as already discussed with you, we have no material weaknesses, significant deficiencies, or other matters to report to you today. And with that ends our required communications. And what I'd like to do is turn it back over to Jim right now, who wants to talk to you about one important upcoming accounting standard.
Thank you, Nancy. Really don't want to bore you with all the accounting standards. I know you rely on your staff to meet that, but as you know, one of your operational challenges is meeting the employee benefits, the OPEB and pension, and as you know right now, you've got 3 pension plans, I believe, that you administer, and there's a divergence in practice on whether those are required to be in your financial statements or not. And management is moving toward including those, which we agree with, and so you're in a process to accomplish that probably by next year, I think, is the plan. And so that will be an improvement to your financial statements that we believe will be a nice improvement. And right now it's the rage in the industry with these, to make sure you're being transparent in your reporting. Clearly, there's a challenge on the operational side to meet the needs of those, but we can say that you've met the disclosure requirements. Given all the buzz over pensions, what we can do is at least tell you that in your footnotes and in your accounting, you're meeting the requirements to disclose the results of your pension, where it is, the liabilities are in the financial statements. There is an accounting standard out right now that when a pension plan is underfunded for various reasons, more of that liability could result in your financials or be recognized. Right now the standard is, as long as you're contributing the amount that your actuary tells you to contribute, according to the assumptions that you work with them, there's no liability recognized in the financials. This standard would actually tell you to put more of the liability on the books. And so if it were adopted in the way it's being deliberated right now, you would have more liability to recognize. And so we're following that standard. We'll work with management to determine if it in fact gets adopted in its current form. But at least know that even all the buzz that's going on, you're meeting the disclosure requirements for your pension and other post-employment benefit plans. And that's important because you issue bonds and people rely on that information in making their rating decisions and so forth. So with that, I guess we'd open it up for any questions that you may have of us.